Good afternoon, and thank you for joining today's webinar, Mid-Year Market Check-In, Are we climbing toward growth or sliding into risk? From Wilmington Trust, a member of the M&T Bank family. At this time, I will hand the discussion over to our moderator, Dave DeLuigi.
Thanks, Robin, and good afternoon, everyone. I'm Dave DeLuigi, Head of U.S. Markets for Wilmington Trust Wealth Management. And in the spirit of providing timely, interesting, and actionable thought leadership to our clients and friends, we appreciate you spending the next hour with us. So having officially entered the second half of the year, the purpose of today's call is to reflect on the first 6 months and look ahead to the major issues influencing the economy and shaping our markets. The One Big Beautiful Bill was recently signed, resulting in sweeping changes to government spending, taxes, and legislation. Trade policy is in flux and tariffs remain in the spotlight, creating opportunity, new risks, but also opportunities across various industries. And the Federal Reserve continues to walk a very fine line, managing inflationary pressures while also responding to signs of a cooling economy. Its decisions in the next few months will be a major driver to market sentiment as well as performance. So in short, we're navigating a confusing, uncertain, and rapidly shifting environment. To better help us understand these topics and how the firm is setting investment strategy, I'm pleased to introduce M&T Bank and Wilmington Trust's Chief Investment Officer, Tony Roth, Chief Economist, Luke Tilley, and Chief Investment Strategist, Megan Hsu. In a fast-moving policy environment and an evolving market, staying connected to your advisor is critical. So please remember that we're here to help. We're here to help adjust where needed in your portfolios and also remain focused on your long-term objectives. So let's get started.
Thanks,
Tony. At the beginning of the year, you used the children's board game Chutes and Ladders to describe the economy and the markets. And at that time, we were facing a new administration and the potential for significant policy change that might result in upside and downside risks. So I thought it might be helpful if you started by dimensioning how these major risks and opportunities have evolved in the first half of the year.
Thanks, Dave, and welcome everybody to the conversation today. Of course, Dave, when we scheduled this meeting for today, a few weeks back, we thought that for sure the Big Beautiful Bill would be completed in law, which of course it is. But we also felt that, I shouldn't say we felt, but we hoped at least that we'd be through that early period in July where we had the deadline for tariffs and we'd have some more certainty than we do perhaps today to be able to have that behind us as well. But as you pointed out, Dave, we continue to sort of exist in this very uncertain moment. And now we've got the beginning of August as the critical period, at least as it seems today, to get some further resolution on what was the longest shoot, which was the tariff situation. It was sort of expected to be the longest shoot, but it turned out to be even longer than we might have imagined coming into the year. So what I'm going to do is I'm going to run through the Chutes and Ladders, the primary ones that we identified at the beginning of the year, with a eye towards, did it turn out to be a bigger risk or upside benefit in the case of the ladders than we anticipated? And then I'm going to say a few words about how we're positioned today and our forecast going forward and why we're positioned today in context of that forecast. So let me jump in to talk about the chutes. And I mentioned the tariffs, of course, already, but reminding everyone, we had a effective tariff rate for many, many years of between 2% and 3%. And now we've moved to an effective tariff rate that's somewhere north of 10%, potentially north of 20%, depending on whether or not we think about the immediate or whether or not we think about what we think will be potentially the new steady state going forward once we have this very volatile period of negotiation and threat and negotiation and ultimately agreement reach a new steady state. And so we do believe that while the new dates that are in August are important dates and we expect to get some additional clarity before then and then, we do think that the new tariff rate on average for the economy is going to be significantly higher than we expected when we came into the year. And that's why we have the chute dimensioned as being significantly longer for tariffs, both in the first half of the year and going forward. And it's not just the fact that these tariffs exist as a tax on the consumer to some degree, but it's also that these tariffs create a significant amount of uncertainty for consumers and businesses, and it holds back economic activity while we're waiting to see how these negotiations unfold. So on the one hand, for the long term, the administration, I think, is doing what it needs to do in order to provide maximum leverage to get good outcomes from the tariff negotiation process. It is having a short-term cost on the economy. And as Luke is going to talk about, we came into the year with a slowing economy. And really important point here, because we tend to be focused on the markets and a lot of the positivity that might come out of the big, beautiful bill in terms of short-term stimulus. But we came into the year with a slowing economy, and with the tariffs weighing on the consumer and uncertainty, we do expect to see almost essentially flat economic growth on a real basis the second half of the year, which is another way of saying coin flip on whether or not we're going to be in recession for the second half of the year. And again, tariffs are a big part of that and really account for the lion's share of our degraded outlook relative to where we started the year. So that's where we are with tariffs. And again, we do expect to get a lot of resolution over the next 30 days. It's not to say we think that they won't kick some more situations down the road, but we do expect to get some resolution, and ultimately maybe on average across the economy, maybe 15% tariffs, which is 7 times higher than where we used to be, but potentially consistent with long-term growth once we get through a period of adjustment. Because remember, with a tariff, there's 4 ways that these tariffs are essentially accounted for in the economic environment. The first thing that happens is companies that are staring in the face of higher import prices, they go somewhere else, potentially domestically. Number 2, the manufacturer abroad who is sending us those goods may eat some of the cost of the tariff. So that's number 2. Number 3, the importer might eat some of the cost of the tariff, thereby impacting profit margins. And that's one of the concerns around the economy. And then lastly, the consumer is going to eat some of that cost. So when you spread the costs around those 4 different areas, essentially, and we make an adjustment in the economy, we think even with these higher costs on imports, we'll be okay. But it's going to take some time for that adjustment to occur. And Luke and Megan will be talking about that. So moving a little bit faster now that we've gotten through the biggest chute, we have the idea of a deficit. And we came into the year thinking that the deficit could weigh on the economy from a fiscal standpoint. And what we had with the big, beautiful bill, it may be surprising that we don't have a longer here, which is to say that because the big, beautiful bill, there was a tremendous amount of narrative around the size of the deficit it would create going forward, that we're not dimensioning this as having a bigger negative impact on the economy and the markets. Well, the reality is that, and Luke will show us this, the bill may be a little bit bigger over 10 years, but we expected that the lion's share of these deficit items would be undertaken this year in the form of the extension of the 2017 tax cuts, and we knew there'd be some other things thrown in as promised on the campaign. And so when you look at the annual incremental cost, it's not very large, and I think that's why the bond market has been able to accept the size of this bill relative to what was expected. And that's why we have this dimensioned, at least for now, as being pretty much what was expected as a chute in the economy. The mass deportations have had an impact on the margin, but not a tremendous impact. Number one, the mass deportations have gotten geared up much more slowly than we might have feared. I think that the bigger impact has been the prevention of new immigrants coming into the country. But in both cases, when we think about the impact that these actions have on the labor supply, it's something that will, I think, accumulate over time, and that over a longer period of time, and when there's greater demand for labor than there is today, where we see a very, very low turnover in the labor market, it stands to be inflationary. But for right now, we're just not seeing this having an immediate impact on companies and on markets in the larger sense. Obviously, you'll see specific sectors that are going to be impacted, agriculture, construction, et cetera. But overall, it's not having a material impact yet on the economy. So this chute was lower than expected so far this year, and we expect the same going forth through the rest of the year. Geopolitics, well, we've probably had greater geopolitical activity than expected this year with the situation in the Middle East and the lack of resolution in Ukraine. We can't say that it's really had a depressive impact on the economy or the markets. So that's why we have this dimension to shorter. And then inflation, the consensus was to continue to see fairly hot inflation and to see the tariffs really push that upwards. But what we've seen, which has been in line with our view, it continues to be our view going forward, is a very persistent disinflationary environment. And that even though we are seeing some impact on the good side, we're seeing, because of the organic slowing overall in the economy and the fact that we tend to be a very service-dominant economy, we're seeing much more slowness overall on the services side. That's more than counteracting any cost pressures on the good side. So that is the summary for the shoots. Now, looking forward for the ladders. So for the ladders, we're seeing CapEx shape up to be a really important part of the economy. And that's happening in context more than anything of technology and artificial intelligence. And it is actually going to be increasingly fueled by some of the provisions in the big, beautiful bill that allow companies to expense or write off all in 1 year the expenditures on their on research, development, plants, equipment, all those types of things, and software. And so the impact that's having on a big portion of the economy and the stock market, the MAG 6 or 7, depending on how you think about it, whether you include Tesla any longer in that description, is a very positive for the economy. And that's been a bigger ladder than we expected this early in the year. And we think it's going to continue to be a significant ladder and tailwind going forward for the markets. Fiscal spending has been pretty neutral, I would say, year to date. But we have this as larger because now that we have the big, beautiful bill passed and we're thinking about the impacts specifically on taxpayers going forward, or consumers, I should say, we do think that fiscal spending is going to be a nice short-term benefit for the economy, where we have lots of provisions, whether it be taxes on tips, overtime, the extension of, for middle-income taxpayers, the SALT cap in those states where it's relevant to $40,000, the child tax credit, the $1,000 accounts for new citizens, et cetera. All of that is going to coalesce, probably create some fiscal stimulus, although there are some other areas like Medicaid and food programs and whatnot that'll work in the other direction. But we think overall, this is a front-end loaded bill that's going to create some fiscal stimulus for consumers on a net basis. And then from a deregulation standpoint, we're starting to see, when you look at these bank earnings, we're starting to see some activity now on the deal side, which is a real proxy for how much deregulation we're seeing in the economy. I would say that it wasn't the primary focus of the administration, as they've been focused on tariffs, they've been focused on the bill. But I think we're going to increasingly see a lot of these agencies start to bring to fruition their proposals and the new laws and rules and regulations that will allow for more deal activity. And that's going to really help to support the economy on a go-forward basis. We just haven't seen it yet, and that's why we have it dimensioned as shorter. Productivity is an area that we think is absolutely vital to the economy. It's always vital to the economy to see productivity gains, but it's particularly vital in an environment where we're seeing some real hits to the labor supply, and we're seeing companies really needing, in order to maintain their profit margins, to be able to deliver more for the same amount of cost or labor base. And so because of the digitization of the economy we've been talking about for a number of years, and it's being essentially accelerated by AI, it's all coming together and coalescing to a very productive environment where we think it is doing exactly what we hoped it would do, and we think that's going to continue. So we're not giving it a longer grade than we did at the beginning of the year, but it's definitely doing what we thought it would do. And then last is the Fed. And the reason we have the Fed here as shorter is because we thought that the Fed would actually start to cut rates earlier in the year. We think that they have not cut rates primarily because of the uncertainty surrounding the impact and the flow through of tariffs. But as Luke is going to talk about, we have a pretty strong view that that flow through on the good side is not going to nearly be as great a magnitude as the flow through of overall economic slowness on services. And we're going to start to see the Fed move much more quickly in the second half of the year to the point of at least 3 cuts between now and the end of the year, which from a consensus standpoint is more than the market is expecting. So that is right now shorter. But if we were here at the end of the year, December, we think that is going to be back to at least neutral as the Fed starts to move. So to pull it all together, before we go to Luke's talk about the economy, let me say that we have a fairly pessimistic view, if you will, for economic growth the rest of the year. We think that we've had, as I've talked about, the slowing consumer that's being weighed on by the uncertainty from tariffs and ultimately some higher prices on the good side. But as we get into next year, we're going to see a reacceleration on the economy. And so the markets, to some degree, are either ignoring or looking through, in our view, that slowness that we're expecting, that degree of slowness in the real economy in the second half of the year. Whether or not that is going to continue to be the case, of course, we don't know, but we're comfortable at the moment with our full allocation to risky assets because we don't think that this recession is going to be deep at all. And to try to time at this point the potential market correction we would get once it realizes how slow the economy is likely to be over the second half of the year is probably going to be too difficult to pull off. Now, having said that, if the market re-rates even higher, we get into the mid-6,000s on the S&P, et cetera, and our economic views haven't changed, look for us to potentially move to a lighter weight on equities. And probably my favorite chart that you're going to look at today is a chart that Megan has, which talks about the overall level of the market, but then breaks it into the Mag 6 versus everything else. And when you look at the overall market, it looks expensive. But when you look at the market as consisting of a small group of highly performing tech companies with big earnings, they still look attractively priced or reasonably priced, and as does the rest of the market when you look at it alone at some 17 times earnings. So that is my favorite chart in the presentation today, and so I look forward to listening to Megan talk about that one again. So Dave, back to you.
Great, thanks, Tony. So Luke, Tony highlighted two of the main policy issues that are outsized and really impacting the direction of the economy, and those are tariffs and the one big beautiful bill. So maybe you could start with the biggest shoot on the game board, which is tariffs. And we've had a tremendous amount of back and forth on tariffs and the rates and implementation dates. So how do you think tariffs are impacting expectations for economic growth?
Definitely. And as Tony talked about, this is one of the biggest shoots we thought as we entered the year. And as we talked about on previous calls, not necessarily the one that we thought that the administration would go after right away. But to directly answer the question, the tariffs are weighing on economic growth. But there's a lot of shifting, there's a lot of pull forward, and then bouncing back from that. So there's a lot of volatility as both consumers and businesses tried to front run the tariffs and then some bounce back. But the overall message that we need to take away is that it is having a slowing impact on the economy, and that's what we're trying to show here. So this is GDP data, but for anybody who is watching GDP data, or if you subject yourself to as many headlines on your phone and news alerts as we get, we had a negative quarter in the first quarter, and you'll see, it's because of imports, and they're a drag on GDP and a subtraction. It's going to bounce back in the second quarter. And what we've done here is to just isolate the parts of GDP that we're really sort of interested in, because GDP is how much do you produce, and it's sometimes better to just look at how much do you want to buy, and that's what this is. This is the components of GDP that we're referring to as private demand. How much are consumers and businesses spending? And so essentially we're taking away the import-export, the buildup of inventories, and taking away the government. And the thing that I would point out here, and I think this is the biggest takeaway, is the downward slope of the line, of the blue line, as we move into this year. So that is the slowing of the economy. And a couple of the components here, the third to last one from the right. So it's almost like an entirely teal bar. That was the fourth quarter of last year, where there was a lot of excitement in markets about, look how strong the consumer is. And we said at the time, look, this looks to be, the consumer's okay, but it looks like really ramping up auto purchases and a lot of things because the president had been elected and was expected to bring in tariffs in 2025. And a lot of that large teal bar there, again, third from the right, 2024 quarter four, was that front running of tariffs. And as we move into this year, you get a slowdown. You get the consumer slowdown, the teal bar just above 2025 Q1, very slow consumer growth in the first quarter. You had that larger gray area, and that was businesses getting ahead of tariffs. There was a 60% annualized growth rate in businesses purchasing and investments of computers, software, cloud computing, all of that kind of stuff that would be subjected to tariffs, and there was a big surge. And then lastly on this chart, what we have is that yellow shaded area. This is the Atlanta Fed. Every single day of the week, whenever there's new data, is updating what is expected to be sort of the tracking for the next GDP release. Today is the 17th. In 13 days, we'll get the actual official data for that yellow area, but this is the Atlanta Fed's tracking of it. And what we're seeing is a continued slowing of this private demand measure. And this is as the tariffs have come on, and we have some slowing job growth and some of the things that Tony talked about, and you're just getting slower and slower aggregate spending by businesses and firms. Even this morning, so we made this chart yesterday with the most updated data. 8:30 this morning, we got retail sales data, which if you saw headlines, it surprised to the upside on a 1-month basis. With backward revisions and considering the first 2 months of the quarter, it actually reduced that number to the far right. So if we updated this chart today, you would see an even lower teal bar for the Atlanta Fed tracker. So we're seeing, and I think Tony described, we're looking for possible decline, that 50% chance of a recession, and that really could go either way. But what we're definitely seeing is that slowing of purchases, especially as the tariffs have started to hit here in 2025 quarter one and quarter two, Dave.
Right. Well, so inflation is the other part of the story, but when you have slower growth combined with higher inflation, which some people expect, that's the definition of stagflation. So maybe you could share, your opinion of the possibility of this.
Yeah, absolutely. And I think this is where, even if we have a more negative view on growth, this is where we have a positive view overall, because from the beginning of the year and even before that, we really didn't expect to see a stagflation or an inflation scenario coming from tariffs, and we've stuck with that. We were sort of not off on our own, not completely, but much more out of consensus at the beginning of the year. But as we've seen that slowing in the economy, we've also seen slowing of inflation pressures. I think the market narrative was, well, you're going to bring tariffs, it's going to cause inflation. And our story was the consumers are not in a good place to take on those kind of price increases. And if tariffs increase the prices of sporting goods, games, computers, all those kind of imports, it's going to take away from somewhere else. And so what we're showing here, and we just got CPI data this week. This is showing the core CPI is the darker blue line, 6-month annualized rate. It's actually very close to the Fed's target. And we also see the dynamics. So taking on that blue core CPI line and breaking it into goods and services, goods much more subject, much more vulnerable to those import prices. That's the teal line on the bottom. And you can see where for most of the 12 months heading into this year, goods prices were actually in decline. And a lot of the impact of the tariffs is starting to show up here, where it has driven the price of goods to a positive number, not really high inflation, but from negative to positive. So we are seeing the impact of tariffs on the prices of goods, but it's not driving up overall inflation. Inflation is the price of all goods when brought together in the entire basket. And that's because of what we had expected and what you're seeing on the top of the chart here, which is that gray line. So those are non-energy, non-food services. We have seen consumers cutting back pretty significantly on recreation, things like movies and fun parks and amusement parks, all of that type of thing, cutting back on travel, airlines and leisure and hospitality, all of those types of things. And that has been the counterbalance as consumers have been cutting back on that services spending in order to afford, if you will, the tariff price increases. And the net effect, as you can see here, is we still have inflation extremely close to the Fed's target, and that's what we had expected. So it doesn't mean it's a positive story, Dave, but directly to the question of stagflation, that's not what we expected because we didn't think that we would get inflation from these activities, and that's the way it's been playing out.
Great. Thanks, Luke. So, Megan, earnings season kicks off this week, and that should give us a lot more information about how companies are handling, the policy environment. What are you hearing in the market from companies about tariffs, especially with the August 1st deadline looming?
Yeah, thanks, Dave. Well, earnings season is very helpful for not only getting a gauge of how companies have performed, but also what executives are seeing in the environment going forward, and in the form of earnings guidance that can be very helpful to understand how companies are seeing the economic outlook from their perspective. And what's interesting is that during periods of significant uncertainty, you can sometimes see companies pull their guidance or stop giving any guidance about the outlook going forward. And we saw that in spades during COVID. We have not really seen that during this environment. We've seen companies instead saying that they're going to maintain their guidance for the most part, and that they're working through many different ways of handling and adapting to tariffs. And this is where I think the current environment is pretty different from what we saw in 2018. At that time, the economy was in pretty strong shape. And what we saw was that companies largely passed through any price increases from tariffs directly to the consumer. Today, we are, as you heard from Luke, expecting and facing a slowing economic environment. Savings have been depleted, and we're also looking at consumers who are extremely inflation fatigued. So what we're finding, and we're showing here a New York Fed survey of services firms and manufacturing firms, basically asking them, how do you expect to adapt or adjust your operations in the face of higher tariffs? And if the bars are to the right, it means that they are increasing that particular action. And if they're to the left, they're expecting a decrease. What we're seeing is really an all of the above approach. Consumers are not really in a position to take on all of the tariff increases, so companies have to adjust for that. The first bar here shows that about 50% of services and manufacturing companies do expect to increase the price of tariffed goods. So some of that will pass through and show up in the goods inflation that Luke just saw. But they're also, on the next horizontal bar, looking at ways to increase prices of goods that are not affected by tariffs, but might have more price inelasticity. So this is where, a company like Walmart, for example, might choose to not increase prices on goods that are tariffed and instead pass them through in other parts of their product portfolio. We are expecting, and you can see in the middle here where we reference capital investments and headcount, that those are expected to be decreased a little bit more for services firms than for manufacturing in terms of CapEx expectations and headcount. This is one of the main risks. You might have some positives from CapEx that Luke will talk about related to the One Big Beautiful Bill. But if there is so much uncertainty around tariffs, companies might end up waiting on those capital investments. And then supply chains. We are seeing companies adjusting their supply chains. So the amount of goods that they purchase from within the U.S. is increasing or expected to increase. And the amount of goods that they purchase from outside of the U.S. is expected to decrease. And this will be something that will affect supply chains and sourcing. It does take time. It can be a little bit more expensive, but I think it would be one of the aims of the administration. And then the very last bar, you'll notice about 40 to 50% of companies are expecting to take a hit to their bottom line. Now, companies have very elevated profit margins, and as we'll show and talk about later, very elevated cash levels. So they're in a strong position overall to take some of this, but this would be an area, I think, of perhaps vulnerability for the market, because we would expect that to show up in reduced earnings growth, and that's not really getting priced into the market today.
Thanks, Ray. Thank you for that perspective, Megan. So Luke, let's talk about the One Big Beautiful Bill. At the beginning of the year, we noted increased CapEx and fiscal stimulus as possible ladders for the economy, and both of these issues are important components of the legislation. However, the cost of the bill and its impact on really the already precarious fiscal state that we're in is a shoot. So, what's your perspective on the economic impact of the bill in both the short and long term?
Thanks for thanks for thanks for
We think it's stimulative in the short term. Over the long term, it's a little bit less certain. We're showing the entire long-term picture here, but I'd really like to focus on that short term. And what we're using here is both the analysis from the Congressional Budget Office, the CBO, which is sort of the official scorekeeper government agency in D.C., very much nonpartisan. They might not be right in their projections, but they're very nonpartisan, and it is definitely the official arbiter of these things and the projections. And then also the CBO, and most of the bars here, almost all of them are labeled as the One Big Beautiful Bill Act. And then we've also included the CBO's estimate of tariffs, which I haven't given the detail on a year-by-year basis, but we've also included it, and showing it as a percent of GDP. So, because the percent of GDP as predicted or as forecasted at the beginning of the year. And the short answer here, and this is in fiscal years, the short answer here is, that first set of bars looks like it's a drag this year, and that's exactly what we're talking about in terms of the impacts and the impacts of tariffs. We've got that reduction in tariffs and some of the impacts of the One Big Beautiful Bill coming in the rest of this fiscal year, the 2025 fiscal year ending before the end of the calendar year. And really the focus here is the stimulus that you're going to get from the legislation on net, even with the tariffs, as we move, let's call it, 2026, 2027, a little further out, and maybe it's not as certain. But you can see where that teal area, the personal income taxes, the darker part on the top of the graph is the business taxes that came through. And then even the spending, we've got a sort of like a pea soup green area on the very top of 2026, 2027 that are showing the other category. So this is one of the things that we noted in our capital markets forecast, saying you have the possibility of increased fiscal spending, despite all of the Doge stuff and the stuff with Elon Musk and all of the commitment to cutting spending. That's definitely true over the longer term. But you actually have increased fiscal spending in 2026 and 2027 relative to without the bill. And a lot of that is on defense and military spending, as we expected and as we put in the CMF, which I think was a little bit out of consensus. So you're getting a long-term impact, and we're going to talk about the overall impact here in a moment. But the last thing that I wanted to say about the impacts of this bill in a strict economic sense is that we have that boost to GDP. This is showing deficits as a share of GDP, but in the short term, that can be thought of as a boost to GDP. Most people are going to spend those personal income taxes, and people will take advantage of those business taxes and do some of the CapEx that Megan talked about. But the other important thing here is this is drawn as relative to a baseline of if the law had not been passed. This is what the CBO does. The CBO says what our laws are on the books. That's going to be our baseline. And then any legislation that comes along, we have to draw it relative to that baseline. Well, until the legislation was passed and signed a couple of weeks ago, the baseline was for all of the personal income taxes to go away. A lot of the business taxes would not have been extended too. So this boost to growth is not necessarily showing relative to an economic forecast. I mean, we thought that the personal income taxes were going to be extended, even if Vice President Harris had won the election. She was saying that she wanted to extend the personal income taxes for all but the upper income. So it was sort of baked in that you were going to get these teal areas. And so that's important to keep in mind, especially as we start talking about, and Tony's going to talk about the impact on bond markets here in a moment, is that a lot of this was baked in. Be that as it may, the passage of the bill really does help to go to sort of the optimistic side of our 50-50 expectation of a recession. We're noting the impacts of the tariffs, which are a drag. But the fact that we are going to keep the personal income tax rates that we have now, those incentives to promote CapEx, and businesses are definitely hungry to do that, certainly helps. And I'd also say that this legislation helps on whatever comes on the other side. And, we've got that 50-50 chance of possibly moving into the recession that could be later this year or into the beginning of 2026. But this legislation sort of puts in place what those business incentives are to do that CapEx, and would result in a reacceleration of growth on the other side. So even when we say 50-50 chance of recession, it's really not deep recession. It's more like a stumble for the economy, and not very long. So short and shallow recession, as we've said in previous communications. The other thing to point out about the One Big Beautiful Bill Act is on the next slide, and this is looking at all of these components, but in a 10-year impact. The 10-year impact, and this is taking the provisions of the bill starting at the top and starting at zero, which of those will decrease deficits. So as you have those healthcare provisions and cutting back on Medicaid, and then you go down to repealing the Inflation Reduction Act and the sort of those green initiatives. Those things are helping reduce the deficit, moving to the left with the teal bars. And then when you get down to that large dark blue bar, the extension of the Tax Cuts and Jobs Act, you get moving over into increasing the deficit. And when you layer on all of the things that come below that first large blue bar, you've got the increases in the deficit. You get to that about $3.5 trillion. That's estimated when you get down to that last very thin blue bar. And then lastly, the dynamic impacts that the Congressional Budget Office has estimated increases the total interest cost. We had flagged this in the capital markets forecast as a possible impact on long-term rates and bond yields. And this is showing down there at the bottom the net impact after you go through the things that help the deficit, and then the things that increase the deficit, the $4.3 trillion over 10 years. And again, just like on the previous chart, I'm going to reemphasize that a lot of this was baked in. So just like when I was saying some of the spending components from the previous chart were baked in for economists' forecasts, that massive blue bar in the middle here, which is the extension of the Tax Cuts and Jobs, of the personal income taxes, those were, sort of figured into markets to begin with. But this is the CBO analysis. The overall look is that we have that increase in the deficit over 10 years, even if a lot of it was baked in ahead of time, Dave.
Great. Thanks, Luke. And yep, even though you're calling for a 50% chance of a recession, I like your idea of it being short and shallow, but let's hope we don't have one to begin with. But so, Tony, the bond market seems to be accepting of the bill. I mean, we had some interest rate volatility earlier in the year, but you've pointed to the 10 and 30-year Treasury yields as important signals, and those seem fairly well behaved. How should we interpret this?
Yeah, Dave, it's a great question. The bond market is so important. And frankly, I can't remember a time in my almost 30 years of doing what I do for a living where there's been as much focus on the reaction of the bond market to policy formation in Washington. And while you framed the question, Dave, in terms of the big, beautiful bill, the other policy formation event that is ongoing and that's had a big impact on these rate levels has been the tariffs. And we saw that we had a big impact in April on the bond market due to tariffs. We even had potentially the real reason that the president decided to kick off for 90 days these reciprocal tariffs a couple of days after he announced them in the now very famous Rose Garden event with the chart and everything, was because there might have been a failed auction. Didn't seem to be enough demand for the treasuries that the government needed to sell in order to fund itself. And we saw significantly higher rates. So if you look at this chart, which shows rate levels since Election Day, you'll see pretty much since Election Day, before the election, it became maybe a little bit more possible, if not likely, that the now president was going to win that election. And really ever since then, for the most part, bond yields have been drifting upwards, even on the longer end of the curve. And so if you look at this chart, you'll see that the top of the chart is the 30-year bond, which I think we think of really as a proxy for how the country is doing on a long-term perspective. relative to deficit and economic growth. And you'll see we're at 5% now. That's the highest level on the chart by a good margin. You see the 10-year, which really represents what is the prospect for growth over the next 12 to 18 months. And if we have a relatively good prospect for growth, that drifts higher. If we think we might have a recession, et cetera, that tends to drift lower. And then the 2-year is really what we think the Fed is going to do. And so you can see here with this upward movement over this time in rates that both the tariffs and the big, beautiful bill have been pretty bad for the bond market, pushing down on bond prices and pushing up on rates. Having said that, when you look at the 30-year and the 10-year being at 5 and 4.5% roughly respectively, we're very happy that in fact we did have the bond market recognize exactly what Luke just described, which is that almost everything that was passed was already baked in the cake. It was expected, and that the incremental spend over 10 years of around $500 billion, so let's call it $50 billion a year, is the part that wasn't necessarily baked in, maybe expected by a lot of participants. And so once the market digests that and digests the idea that the tariff levels are going to be consistent with, with ongoing real growth in the economy, if in fact that turns out to be the case, which is our view, as long as these tariff levels end up around 15% or so and not 30% or so on average across the economy, then we think that we're at a level of incremental indebtedness that the country can handle. And that's why we are where we are now. And, hopefully the big, beautiful bill is behind us. Now it's really just a question of where those tariff rates end up to see whether or not the bond market will accept that level of additional tariff burden on the economy as being consistent with real growth that's close enough to trend that we don't have to have higher rates.
So Tony, with that insight on rates, what does that mean for the housing market?
Yeah, it's such an important question, Dave, because when we think about the future of the economy, we think about the acceleration after a recession, let's just say, or an economic slowness. The area of the economy that is the weakest right now, a major area of the economy, is the housing market. And so you can see here these two lines, the gray line and the blue line. The blue line basically shows housing activity. It shows transactions, both new and existing homes. And if you go all the way back to shortly after the housing crisis, almost 20 years ago now, what you see is that we are at the lowest level by far of activity in the housing market. And you could see that has directly to do with the affordability of housing as represented by the rate of financing housing, which is tied to the 10-year bond or at the average mortgage rate. And mortgage rates are really teed off of the 10-year bond, not the 30-year, even though they may be 30-year mortgages, because the average mortgage only lasts 7 to 10 years, and then people move or they do whatever they do, they refinance. So we're at a period now where we really need to see, as Secretary Bessent has described and in fact predicted, we need to see that when we start to lower the policy rate at the front end of the curve, that the 10-year starts to come down too. And we need to get that 10-year below and meaningfully into the 3% range in order to get this level of affordability and transactions in the housing market at a higher level. Excuse me. And if in fact we're right and we get this economic slowness, then that is in fact what we would expect to happen. We would expect to see the 10-year start to come down, not necessarily the 30-year, so a significant steepener in the long end of the curve. But in the short end of the curve, which is to say, let's just say 0 to 10 years, the whole part of the curve comes down as you get economic slowness, and the Fed starts to cut, and that helps to really get the housing market going again, and a healthier housing market with more transactions, more supply, and ultimately more affordability. And the one thing I'd like to just mention, Dave, it's not part of your question, but I know that people are thinking this, and it's a question that I've asked Luke probably every other day now for the last several weeks, and he keeps giving me the same answer, but I keep asking him because people keep asking me, and I want to make sure I'm giving everybody the right answer, is, well, okay, that's if in fact the front end of the curve drops and the Fed lowers rates. What if that doesn't happen and then the president fires the Fed chairperson? Then what happens? And Luke's answer is, well, don't worry about that. That's not going to happen because all the conditions are going to be present where the Fed should lower rates starting in September, and that's exactly what they're going to do. So, good for you, Luke. Keep on, being an economist and avoiding the question. But I think that you're right, actually. I think that the conditions will merit the Fed to cut rates. We've got a very tight economic, restrictive environment today with real rates over 2%. And as we move forward and we continue to see this continued disinflation across the overall aggregate, as Luke describes it, there's really no reason for the Fed to stay this tight. And so the Fed should start to cut rates, and that'll also therein relieve this pressure of the dynamic between the president and the Fed chairman. So I wanted to add that to the picture too, Dave.
Good. Thanks, Tony. And, with Luke's view on rates and what the Fed's actions might be, it's certainly an indication that the economic outlook has darkened a bit. However, U.S. equities are trading at all-time highs. So bringing Megan back in, we were hoping that she could help explain this.
This is my favorite chart. I love listening to her explain this.
Thank you, Tony, and thank you, Dave. We've definitely seen a remarkable rally in the market. The S&P 500's up about 26% since April 8th. Fun fact, this is the fastest round trip in history from a 15% correction. So if you felt like you got whiplash, it's accurate based on what we've experienced. And here we're showing overall price to earnings ratio, so a common metric for valuations of the equity market, and the S&P 500 is the teal line there. You can see that going back at least the past 10 years, and if you went back further, you'd see that teal line is in the 97th percentile of history. So we're up there in terms of evaluations and what's priced in. But interestingly, if you pull apart the index in some ways and you look at the Mag 7 or another proxy for mega cap tech, that's the dark blue line. You'll see that those stocks are more expensive, but they are more expensive for a reason. They generate significantly higher earnings than the rest of the market. Those earnings have been consistent and durable and are expected to continue. And those valuations are, as you can see, well off the COVID period when we thought we'd all be on screens forever and never see anybody in person again. So stretched valuations maybe, but not really, certainly not in bubble territory for technology stocks in our view. And then if you look at the gray line, this is a proxy for sort of the rest of the market or the average stock, if you will. So here we take the S&P 500 and equal weight all of the stocks so they all get the same weight and you're not distorted by the bigger companies putting more pressure on index valuations. And here you can see we're kind of at average valuation. So there is still value in the market. It's getting a little harder to find stocks that we get really excited about, and we are focused on higher quality stocks. So in some of those cases where you're looking for companies with low leverage, with steady, strong, consistent earnings, you do have to pay up a little bit. But the market is not overly expensive in our view, even though we are back at all-time highs. Another really encouraging dynamic as we think about the earnings season, which we started to talk about earlier, Dave, is what we've seen in the US dollar on the next slide. So the dollar has depreciated about 10% year to date. And without getting into why and the Sell America trade and whether the US is no longer exceptional, the bottom line for earnings, as we think about the second half of the year, is that this is a tailwind for U.S. large cap, which the S&P 500 generates about 40% of their earnings from overseas. So a weaker dollar makes those goods and those sales a little bit more affordable, helps to boost earnings for big multinationals. And a rough rule of thumb is that every 1% depreciation in the dollar translates to about 0.5% of earnings growth for the S&P 500. So as we've thought about this, steady depreciation of the dollar, we do expect this to pass through into a more favorable earnings outlook as we think about the second half of the year. We also know that companies are faced with a lot of decisions around, as we talked about earlier, do I pass through costs? Do I eat it on my bottom line? Do I change supply chains? And the good news is that companies are very well equipped today to handle this type of environment. That doesn't mean they're immune. That doesn't mean we won't have to see at some point maybe some downward earnings revisions if our economic outlook holds out. But we are looking at companies that are sitting at cash levels on average over the past 5 years that are about 25% above pre-COVID levels. So whether it's margins or cash balances or other measures of corporate balance sheets, companies are in good shape, which is also why we think about maybe a slowdown in the second half of the year, but we do expect it to be short and shallow because companies are in good shape, and we don't see any need for this to really lead to a prolonged period of halting hiring. And then lastly, a ladder that Tony mentioned at the very beginning, regulation. We haven't talked about it too much. We haven't seen all that much in the way of regulatory changes, but a lot of these are, as we know, not necessarily laws that need to be passed. It's how they're enforced, and a lighter regulatory environment, as well as even additional regulations, such as around crypto, that put guardrails on parts of the business and different industries, can be helpful for spurring capital markets activity. Here we're looking at M&A, deal count in the teal, and then deal value in the blue. And we're seeing deal value move up because some big companies are making some big acquisitions. We would expect, as we get more certainty around trade and lower rates, that deal count would also increase as we move into the second half of the year.
Great. Thanks, Megan. So Tony, can you bring us home and help us tie all this together as we move through the second half of the year? What are the most important sections on your game board of chutes and ladders, and how do you expect this to translate into the financial markets?
Yeah, thanks, Dave. So real quickly, I think that there's two things. One is the tariffs, and the other one is the level of the market, and we figure out what to do from there. So a lot of the uncertainty is behind us as it relates to the policy formation in Washington. We have a good idea of where the inflation picture is going to resolve. And at the end of the day, we have continued uncertainty on tariffs, but we think that there's been enough back and forth in that dialectic, if you will. Excuse my philosophy background, I can't help it. That we think that at the end of the day here, we are going to end up with tariff levels around 15% or so on the economy, which is a big increase. It's one of the big reasons that we weigh down the economy this year, but maybe it's for enough long-term benefit that it's justified. We'll see over time. And if that happens, Dave, then we're optimistic about 2026 for a lot of the reasons that Luke talked about, where we see that stimulus coming forward from the bill, and we get a reacceleration, and hopefully the housing market can really help with that. And if that happens, then look for us to maintain our positioning in portfolios. I want to really thank the team with the accuracy of Luke's forecast, the steadiness of Megan's hand on the helm here from a strategy standpoint. But the vast majority of our portfolios, net and manager fees, have outperformed the market with all this volatility and are up even more than the market overall, on a blended basis with all the different asset classes. So we've done remarkably well here. And I think that we're going to probably maintain fairly consistent positioning here, which is to say a full allocation to equities, but with a bias towards both tech companies and quality within U.S. equities. And then on the fixed income side, we would expect to see credit spreads widen and defaults increase as we go into a potential recession or even just a very significant economic slowing. That's how we're positioned today. If, in fact, the market continues to race forward looking through the recession into next year, and we get to levels of the market that are even higher than where we are today, meaningfully, let's say another 5% on markets, then I think that with that economic outlook, we may look to de-risk a little bit because we think that the probability of correction gets even higher. But for right now, the neutrality in the portfolios overall, with that bias towards the tech on the one hand and the quality on the other, with a very conservative positioning within bonds, as you start to see credit spreads widen out or defaults increase, is exactly the right place to be. It's worked really well year to date, and we're going to stick with that plan for the moment. So again, thanks to Luke and Megan for the steady hand in getting us to where we are so far this year.
Great. That's a perfect summary, Tony. Thanks. I guess to wrap up here, Tony, Megan, and Luke, all of us appreciate your perspective on all of this, the new legislation, tariff policies, the regulatory environment, and the Fed's possible decision on rates. There's so much more in store for the second half of the year. So to our audience, despite the shifting economic landscape, one of the consistent themes for Wilmington Trust and a core commitment of ours to is our clients. And with so much in motion, staying connected to your advisor is critical, and we're here to help you make informed decisions. So please reach out. We're here to help. Thanks for your time today, and we appreciate your relationship with us.